We had a capital partner that didn't match our business plan. We had a private equity oriented investor who is looking for a return in a short period of time. A franchise business model takes time. You don't do that overnight.
There's a common myth that says like the best location is always the one with the most traffic. Would you consider that being true?
I have 44 years in this business. The first 18 years of it, I was a real estate company guy for Holiday Inns and Wendy's and Quaker State. And I didn't know how to make hamburgers. I didn't know how to run a restaurant. Find something you love and then go to a company that does what you love. At that time, there were no shopping centers. I know it's hard to comprehend, but shopping center development started in the early 60s. The biggest deal for us was going to a McDonald's that had opened in 1958.
Wow.
There's a concept called Hotelling's Law, and it's a law of kind of clustering. So if you have one restaurant in a market, another restaurant comes in, it expands the market because you have more people coming to one intersection to have a choice. One of the basic fundamentals is to be able to project your revenue for that location and the resulting cash flow enough to cover your rent comfortably. And we always used to use kind of a 1.5 to 1 ratio for EBITDAR, earnings before interest, taxes, deductions, and rent, financing correctly with the lowest interest rate that you can find. And again, it depends on the time. 10 years ago when rates were 0 and 2% is different than they're at 6% today.
But when it comes to commercial real estate, is there anything that operators can do within a saturated market that may not be performing as well?
Well, I mean, it seems kind of like a...
Hello, everyone. Welcome to the first ever interview for Money Talks Media. This is a little bit of a different format as I have my interviewee, Jay Bastian, here with me today. Over the past few years, I've been doing solo content, so it's a little bit different format as we're doing like a one-on-one interview. For context, Jay and I have been knowing each other for around like five or 6 years now. Back in 2020, we met through the Score Mentor program where I was focused on doing some franchise work back into the restaurant space. And from there, even though that venture didn't necessarily work out, we still stayed in touch since then. Yeah, I consider Jay as one of my 10-10 forever rule relationships. And it's good because like one of my virtual mentors, Sharon Sravasta, came up with this principle as far as saying like, hey, these are the 10 people I'm gonna grow a relationship with 10 years plus. And that is what created 95% of his net worth. And so I'm taking that same principle and applying it to my life, and hopefully you can too. And so that's why we are creating this video interview. And so there will be many more. So get ready, like, subscribe, turn your notification bells on because this will not be the last one. This video is going to break down 3 different parts. So the first part, within the commercial real estate space, we're going to talk about what actually makes a location work. The second part, we're going to talk about why strong brands still fail to scale. And then the third part, we're going to talk about how big dog investors really think about investing in commercial real estate. And so if you're building, if you're scaling, or if you're investing, this will be a much clearer lens on how to move forward. So without further ado, I'm going to introduce Jay Bastian.
Thank you, Josh. Nice to be here.
Yeah. Well, we're excited to have you on here. And so like while we begin, could you start by telling us your origin story within your career and what drew you to commercial real estate?
Yeah, sure. Well, I grew up in the 50s, early 50s, in a small town in southern Ohio. There were 2 brands in town, along with 1 traffic light. We had a Pure Oil station. We had an IGA grocery store. That was all we knew of kind of brands back then. There were no shopping centers. The largest town that was near us was Columbus, Ohio, capital city of Ohio. At that time, there were no shopping centers. I know it's hard to comprehend, but shopping center development started in the maybe early 60s and really gained a lot of strength in the 70s to 80s. Malls, shopping centers, and along with that, brands like I remember the biggest big deal for us was going to a McDonald's that had opened in 1958 in Columbus, Ohio, on the south side of town, which was new to us. I was going to say, there were no branded restaurants. There were no branded um, hotels, lodging, retail. I had a Kresge store, which is your five and dime store, they called it back then.
Yeah.
But really not much in the way of brand. So I started, I guess, at that point, and we'd travel. We would go stay in a Howard Johnson's or a Holiday Inn's, which again was new to the environment. So maybe like a lot of people, baby boomers in that age, you started to adopt brands. You become aligned with a particular brand for what they offer. And brands started coming out in all kinds of retail, restaurant, hospitality segments. And so I think that's kind of my, sort of visual background as I started seeing these things start to develop. A couple of years later, after the McDonald's opened, an Arby's opened next door. And so after college, it's like, well, what are you going to do? That seemed like an industry that was growing. And the real estate side of it was kind of interesting to me, and that I remember there was a real estate guy that lived in our little town that lived in a nice house and drove a Cadillac, and I thought, well, that must be a pretty good job if he's able to do that. And I started translating it out to, well, somebody's got to be finding these locations for McDonald's and Arby's and building these shopping centers. And sure enough, there was an industry out there. And there was a trade group called International Council of Shopping Centers, which I joined, became part of, and spent 44 years with. So it was all the people that build, finance, and tenant shopping centers and malls across the country.
Wow, that's powerful. Did you have, like, I consider you as one of my mentors. Would you say you had mentors to help you break into the industry or give you guidance?
Yeah, I think so. My first job out of college was with a large franchisee of Holiday Inns and student housing properties. And one of my original bosses helped me with, how they underwrote locations, developed market plans to build out a market. As an example, in Columbus, Ohio, how many Holiday Inns would you build there that serve the market without saturating the market? So, yeah, I think that was sort of my first taste of that.
Okay, well, cool. So obviously, like, with the audience that I have on my channel, like, some of them can be operators and some of them can specifically focus within commercial real estate operators.
Yeah.
I mean, being an operator within commercial real estate. And there's a common myth that says, like, the best location is always the one with the most traffic. Would you consider that being true?
No, we always used to say, because that comes up a lot when we were analyzing locations. So somebody would say, the real estate broker would say, that's the highest volume McDonald's in town, or that's the highest volume whatever in town. And there's a famous philosopher, baseball player named Yogi Berra, and he said, that's so busy that nobody ever goes there anymore. Right?
Yeah.
You've heard that before,
Yeah,
but it's true.
Yeah.
The highest traffic doesn't necessarily mean it's a great location. Traffic has a couple different variables. It's commuter traffic, where people are going from one place to another. It's high speed. There's local traffic, where people are stopping to go to the grocery store and other services. So it really depends on your business, what your product and concept is geared toward.
Yeah, that makes a lot of sense. And so, like, since the brand is Money Talks Media, most of the audience may not be CFOs, like chief financial officers. They may not be people that are embedded in finance. But obviously there are financial metrics or inputs that are very important to understanding if their location may be an asset or a liability. Are there any metrics or inputs that you would say to look?
Well, I think when you're evaluating a location for a new business, whether it be restaurant or retail or whatever, and the first thing is whether you're buying or leasing, is the rent or price of the property at market. Are you paying what the market bears at the moment? Is the property or the market in the growth path, or is it in a stable, never going to be bothered market, or is it in a declining market? Those are the main things that you would look at in terms of underwriting a new location.
Okay.
And obviously the strength
Yeah.
of the market. If you're coming in with a fast food restaurant focused on hamburgers, how does everybody else in the market do? You've got to find out what kind of volumes they're doing, what their day part strengths are, breakfast, lunch, or dinner, to really analyze whether there's room for another one.
Yeah.
There's a concept called Hotelling's law, and it's a law of kind of clustering. So if you have one restaurant in a market, another restaurant comes in, it expands the market because you have more people coming to one intersection to have a choice.
Yeah.
The more restaurants you get at that intersection, the more choices you have, the more it attracts people, as opposed to locating, a mile away where there's no competition, where there's no choices. So that's, I think, another thing to consider is what is going to attract people to the market. Is it a grocery store that has visitors throughout the day? Is it just a high traffic location where people need to stop off as a freeway type of location?
Yeah, that makes a lot of sense. And you mentioned restaurants, and obviously our relationship have been around the restaurant space when I was interested. Could you give the audience maybe some more context around like your last experience, like working within the Wendy's brand? And
Well, I worked with Holiday Inns, as I mentioned in the beginning. I also worked for Photomat Corporation, which to you young folks wouldn't know what that is, but that was a small kiosk that put on shopping centers that sold and processed film for you, which we don't use anymore. But I was with Quaker State Corporation, obviously Wendy's International, where I spent majority of my career. And we would build hundreds of locations a year. So you really got both franchise and company. So you really got a cross section of what's working, what doesn't work with these properties.
And obviously working within those larger institutions, maybe medium size, maybe even smaller ones. I'm not sure if they were small, like employee wise or even like assets wise. Like, is there any rule of thumbs that people should look at when it comes to location selection?
Well, I think I kind of alluded to it earlier is, what's the value? What's the value piece? Is the rent you're paying to the market or the price of the property you're buying on a per square basis at market? How's the access, visibility, parking, signage? There's so many variables to site selection. In fact, I mean, over the last 30, 40 years, companies have tried to come up with a program that will analyze a location based on all these variables and input and provide you with a go no go sort of analysis. Gotcha. But it's impossible. There's just too many variables. And then you've got to really look at what is the strength of the market? What are the competitors in your space doing? And how does your location and operation compare to theirs?
And so whenever you mentioned analyzing the market value and everything, are they using tools or are they using like mainly like Excel spreadsheets and stuff to do that?
Probably.
Yeah.
Back when, and it wasn't that long ago, but you could go to the county's tax records, find out what people were paying for their properties. You could talk to the local real estate brokers in the market that are marketing properties that would give you comps on what was being sold and what rents were.
Yeah.
So that information is readily available. It's probably, to your point, maybe to an Excel or some sort of a website that provides that today, but that's the easy way to do it is just talk to the market.
Yeah. Wow. So doing that, got you. Doing the research there. So you talked about market, and obviously you mentioned competitors. And there's this thing in every industry when it comes to market saturation, especially within like YouTube. There's tons of creators out there. Market saturation. You have to you have to find a way to distinguish yourself, to be different, to be competitive, while still remaining within your ethical values and everything. But when it comes to commercial real estate, is there anything that operators can do within a saturated market that may not be performing as well?
Well, I mean, that seems kind of like maybe a bit of a double-edged sword. A saturated market would connote that the operators are all struggling to just cash flow. And by doing that, they scale back labor, Maybe their service isn't quite as good. Maybe they've backed off marketing. So those kind of markets you start to see and really analyze to say, well, this market is not growing. It's saturated. There's no more growth. Maybe the market's shifted. You can, if you've been around Charlotte long enough, you can drive some areas and determine that a market is starting to deteriorate and people are moving further out. So it's those kind of analysis, and there's not much you can do if the markets start to are saturated and there's no growth, upside growth there. There's not much you can do about improving it.
Oh, true. Yeah.
I mean, I guess you could lower prices, but that's kind of a double-edged sword. And if you can't afford to hire labor to provide good service, then that's a double-edged sword. So it's unfortunate. That kind of goes back to when you underwrite a location, make sure it's in a growth market or a stable. A lot of people call them A markets. In Charlotte, it'd be a South Park.
Oh yeah.
It's not going to go anywhere. It's always going to be a great market.
Uptown as well.
Uptown
as well.
Some parts of Uptown, yeah. I mean, Uptown itself, the epicenter is a good example of something that's gone bad in a strong market. So just got to be cautious.
Are you aware of any trends that may be going on with the whole work from home policy that a lot of these corporations are implementing to getting people to come back to the office? Do you know if there's anything that's driving that?
Well, I mean, I wasn't from the office side of commercial real estate, but I suspect that that's a strong driver is office landlords are, leases are coming due or rents are being renegotiated. The tenants are in a position where they've got to fill the space or renegotiate a smaller space or relocate. So unless the tenants can get the employees back to work, it's kind of a bit of a moving target.
I could see that. Definitely lots of mixed opinions about that. And we always see, especially on the finance side, when we look at companies like, since I work for a large bank, they have certain lines of business, and each line of business have a profit and loss statement. And a part of that profit and loss statement is occupancy expense. And they calculate it off like number of cubicles, like the occupancy rate, like seeing how many cubicles are filled. And each one of those cubicles costs $1, and it rolls up within every line of business. And so I'm just imagining it seeing that on a much larger scale with the total institution. So that's what I was asking. So no, thanks, Jay. That's super valuable insight, and I'm sure the same thing applies across the world and wherever you're sitting today, to the audience, wherever you're sitting today. So we pivot to founders that have legacy or brand driven industries. And the first person that comes to mind is Arnold Palmer, the legendary golfer. He built a brand. He's built a brand. He's formed plenty of strategic alliances, but his model that he built was struggling to scale. And so, even though it's backed by a premium brand and name by himself, what have you found that made him struggle to scale his operation?
Well, yeah, just a little background. Mr. Palmer had a variety of businesses, as I'm sure you know. One of his businesses was the design business, which architectural design of golf courses, which flourished. He had a management company, which I worked for a couple of years. We were attempting to create the Palmer brand on golf courses and to roll up golf courses into a real estate investment trust. So it was a separate entity that wasn't that he was involved with, but he wasn't in an active day-to-day business. I think we had two issues with kind of expanding that concept. One was we had a capital partner that didn't match our business plan. We had a private equity oriented investor who is looking for a return in a short period of time. Building a franchise business model, which was really franchising branded business model, takes time. You don't do that overnight. And so the there wasn't a capital match between the growth plans and the capital. Number
Gotcha.
two, there's kind of when you're looking to change an industry, and we were looking to take over, to take a service philosophy to golf that you might have seen with companies like Home Depot, where you're providing instruction, you're providing retail at sort of competitive prices, and you're providing an experience that's consistent from one course to another. Well, that was a great idea, but you're working with people in the golf industry who don't think they need to change. So it was difficult to make those modifications to personal behaviors for people that work in the industry. So that was, that's the thing with expanding the brand. Customers on an Arnold Palmer managed golf course expect the things that Mr. Palmer was known for.
Got you. Yeah. Just because his name was behind it.
Well, they have a higher expectation because his name was behind it.
Yeah.
Over what a non-branded course would be.
Got you.
And if you don't deliver and exceed those expectations, you're not going to succeed.
Yeah, and I'm sure he had investors behind him. Maybe he did. Maybe he didn't. And they were expecting returns as well. So,
yeah.
Wow. Shoot, I'd love a deal with Arnold Palmer. I mean, I'm not a big golfer, but I mean, shoot, just to have his name behind anything.
Yeah.
So
it comes with a high cost. I mean, you've really got to operate above and beyond what anybody else does when you have that kind of brand that is representing your business.
Wow. And so while we talk about big names, like so the franchise experience that I was interested in was the McDonald's concept. And then that founder, Ray Kroc, who him and his brother founded the concept, selling ice cream machines, I believe, or selling equipment to McDonald's before they purchased it. But when everyone thinks of McDonald's, they think of Ray Kroc. And ironically, McDonald's is a real estate business. They don't just sell burgers, but they sell real estate, and they own their real estate too. Or they're mainly a real estate company. And so with human-centric brands, are there limits to becoming a scalable system when it comes to having someone's name back behind a franchise brand like that?
Well, I think McDonald's is is probably less Ray Kroc than it is McDonald's. And I think, McDonald's was first and foremost in the fast food business. They provided a price point that majority of the demographics in the early 60s and 70s, they met the service-oriented, they developed a service-oriented culture, second to none, that really everybody sort of followed. Service times, friendliness of service, a marketing program, and all these things are brand elements. They're not Ray Kroc. It's what McDonald's means to the customer. So that to me is, and it's true with any real brands out there. If you are going to stay at a Marriott, you expect a certain level of service. You expect a nice restaurant. You expect a nice room with upgraded linens and So those are kind of brand elements that I think are important. When you start, and we talked about the Palmer thing, I think when you start with a person in a brand, it's just a slippery slope. You've got to really have a concept nailed down before you kind of blow it out and expand on it.
Yeah. Just going back to the Arnold Palmer story, do you think that their company had enough resources to scale, but maybe just the expectations were too high with all the customers? Yeah,
I think for a limited time there was resources to scale that brand, but it was more the execution of it.
Gotcha.
And the sort of, I don't want to say the nature of the golf course operators, was just inherited.
Yeah.
They've always done it this way. They're not going to change, no matter if Arnold Palmer's name on it or not.
Yeah.
So we'd go in and we'd convert a course and put up the signage and branding, and the pro was supposed to be out on the driving range giving free lessons, and the merchandise was supposed to be, less than what you'd expect in a normal pro shop.
Yeah.
And the minute supervision would leave, they'd go back to the way they always operated.
Yeah.
So it was kind of tough to pull that off when you didn't have buy-in from your operations staff on site.
Gotcha.
And then, dealing with the investor was saying, we need results, we need to.
Yeah. Of
It
course.
wasn't a good match. So I think that's a good lesson is, make sure that your capital that's supporting you is a good match with your business plan.
Yeah, that's true. Yeah, financial planning is definitely a big piece of a business success, for sure. All right, so Jay, you've underwritten billions of dollars in capital, and you've worked for these larger institutions. And for someone that's evaluating a property, like as an investor, you've seen trends, you've seen patterns, you've seen the mistakes that's being made in the market. I'm guessing you're still actively investing in real estate, maybe like REITs and stuff like that. Got you.
Yeah.
Are there any mistakes that founders make when structuring deals that are tied to commercial real estate?
Yeah, I mean, when you say founders,
I'm sorry, investors.
Well, if you're talking about founders who structure deals that are tied to real estate, I guess I was thinking you were talking about operators, like retail restaurant operators that are doing a new location. How did they structure their real estate deal?
Yeah.
And that has long-term implications because you've got to live with that property for the term of the lease.
Oh yeah.
So, the key fundamental there is to make sure that your rent is well covered. And for an investor, somebody who would buy that property also needs to make sure that your rent is well covered. So that to me is one of the basic fundamentals, is to be able to project your revenue for that location and the resulting cash flow enough to cover your rent comfortably.
Gotcha.
And we always used to use kind of a 1.5 to 1 ratio for, we call it EBITDAR, so earnings before interest, taxes, deductions, and rent.
Oh, and rent. Okay, got you.
It's got to be 1.5 to 1. So if you've got a $150,000 location that's cash flowing $150,000, you wouldn't want your rent to exceed $100,000. Yeah. It's just kind of that kind of analysis that you as an operator and investor need to take on when evaluating a new location, just to make sure that this is a comfortable to pay the rent location, and for the operator, I'm going to have plenty of cash flow left over to after paying the rent.
Got you.
And that, then aside from that, it's, as we talked before, the same thing. Is it in the growth area? Is it in a stable market that's never going to change? Is the rent to market? Is the property value to market? Those are the kind of underwriting that you want to do.
Yeah, that makes sense. And if someone was interested in buying a REIT, they could probably go to Yahoo Finance and look at their profit and loss statements and try to calculate that.
Every publicly traded REIT out there does earnings calls and files 10K, 10Q reports that provide all that information, and you can understand what their tenants, rent coverage ratios are, what the REITs dividend coverage ratio are. There's so much information. It's pretty easy to analyze, and, it tends to be the REITs with the best performance trade at the lowest dividend.
Yeah, well, that's probably helping them stay sustainable too,
Exactly.
like long term, to stay in business and stuff. Like for a first time investor, would you recommend them investing into a REIT?
Well, I mean,
commercial real estate.
There's REITs across all types of real estate. I mean, there's office REITs, there's industrial REITs, there's call center REITs, there's data center REITs now that are hot. There's cell phone tower REITs, there's billboard REITs, there's...
I had no idea. Wow, really? Okay.
Yeah. So, and they all kind of ebb and flow with interest rates and the hot part of the market. So right now, office is not so hot.
Yeah.
Because of what you alluded to earlier. Data centers are. So data centers that are trading at a premium, office market is trading at a discount. So if you're an investor, if you're able to pick one of these cycles and say, well, everybody's running from office now, I believe in them long term, this is a good time to buy.
That makes a lot of sense, yeah.
Yeah. If you want something sure for the near foreseeable future, then your data centers. And logistics centers, warehouses, which is, the world has gone to warehouses.
Yeah. Yeah. Especially these massive companies, they're investing in warehouses
Yeah.
too.
Yeah.
So,
So yeah, there's a REIT industry organization called NAREIT that provides a lot of information on all these different REITs out there, and so I'd highly recommend looking at that if you're interested.
okay. Cool. Well, I'm going to do some extra research in that too as well. So we think about ownership of infrastructure in real estate. And obviously, we talk about wealth building a lot within the videos that the audience may watch. And typically, owning the infrastructure of real estate compounds wealth a lot faster than income alone. Would you say that's true?
Mm-hmm. Oh, but yeah, I think you can. I think you can. A lot of the growth in your real estate valuation comes from going back to the fundamentals again,
Yeah.
buying in the right spot, financing correctly with the lowest interest rate that you can find. And again, that depends on the time. I mean, 10 years ago when rates were 0 and 2% is different than when they're at 6% today. So it's a combination of that. It's picking the right tenant that you know is going to be there long term. That depends on the credit of the tenant, the health of the tenant, the health of the industry. I mean, when we started investing in the early '90s in the real estate investment trust I was with, Kmart was an investment grade credit. Walmart wasn't.
Wow.
Yeah. So, and things have changed, and it didn't take long for Walmart or Kmart for that whole thing to reverse, right?
Yeah.
So it's a matter of really carefully underwriting who is your tenant, who's going to pay your rent. Are you comfortable with them long term? The compounding opportunity with owning real estate is, okay, I've owned it for 5 or 6 years. It's in a growth area, so people view it as a good opportunity. I can sell it for a profit. I can trade that property into another property at higher value without paying taxes. It's called a 1031 exchange. I can refinance the new property with hopefully lower or equivalent interest rates, and then keep repeating that years and years and years. And that's how you build wealth that way.
Got you.
You understand
Wow.
the 1031 exchange
idea?
Yeah.
Yeah. I mean, well, maybe for someone that doesn't, could you explain the 1031 exchange?
Sure.
idea?
I mean, it's if you've had a property for a while, you have a gain on the property. Say you bought it for 100,000. It's now worth 150,000. I'm going to sell it for 150,000. Traditionally, you would have to pay taxes on the difference between 100 and 150 or $50,000. Well, if you trade it into a property of equal or greater value, you defer those taxes. So you don't have a tax bill. And you now have a property that's worth more than what your original investment was.
Gotcha.
And you keep deferring this until at some point in time, and maybe it's your heirs, have to pay the taxman.
Yeah. Hopefully never.
Yeah, you can keep going.
Yeah, keep on going.
Yeah.
Wow, I didn't know that really.
Yeah. Now, Congress has been trying to repeal that for quite some time, and so far they haven't, because I guess they've got a pretty strong real estate lobby in there, but that's available to people now and has been for quite a while. There's a whole industry on it if you just look up 1031 exchange.
Industry? Like as in companies helping
Yeah.
both investors or only other real estate
Investors,
companies?
investors, brokers, financial planners. It's an entire industry.
Yeah.
Yeah.
Man.
Yeah.
And I'm assuming they're the middleman between, I guess, the deal, like I guess between the taxes and the client on their end too.
There's always a middleman.
Yeah, there's always been. Yeah. One day I hope not too many middlemen. Nobody's making money, you know.
That's
so,
right.
so
Yeah.
oh man, so you mentioned rent, you mentioned cash flow with the tenant paying, like how much money they have available to keep paying rent long term. Are there any other financials that immediately makes you want to walk away as an investor when evaluating?
Well, the tenant's balance sheet. I mean, the amount of debt they have and the ability to serve it, and what sort of term is on the debt. When does it expire? When do they have to refinance? That's the biggest issue that we would have in analyzing a tenant. How I know they're able to service our rent, but how about their debt and the whole company level?
Yeah.
So that's the largest one I could think. Obviously, if they're not trending, you want to look at a 3 to 5 year financial history on a tenant, determine they're heading in the right direction, profitability is better or increasing. Those are just obvious financial metrics that you want to look at, but in addition to the debt.
Well, on the bank side, a lot of the underwriting teams are being a lot more tightened, like more stricter on these loans when they're giving them out to businesses, whether owning the real estate or using it as like a payment for each and every month of rent. So that's definitely a big one. So it means like if you have a company, you have to really have a lot of runway because they're looking at liquidity, they're looking at cash flow, they're looking at how long you've been in business. Yeah. They're looking at so many, your education, they're looking at so many factors. And so that's why it's important to really understand your financial piece of it. So
yeah, definitely.
Got you. So every few years there's so-called a hot sector. Mm-hmm. Right. And so there's a lot of cultural hype in real estate around that hot sector. Are there any durable investment opportunities that would be considered inside of that hot sector?
Well, I mean, today would be data centers. That's kind of the hot sector, and they're priced at a premium because that's where the universe thinks the world is going. Yeah. And anybody that can build a data center and has a data center tenant is going to be protected long term. In a lot of communities, if you just scan the news nationally, a lot of communities are rejecting data centers.
Wow.
Because
high risk?
They don't want this large behemoth building that has enormous power and water requirements in their backyard. Yeah. So that kind of makes the existing data centers a little more valuable because they can't build as many as they thought they could originally. Yeah. But I think, but you pay up for that as an investor. You get a lower dividend on your investment in those type of stocks than you do if you were a contrarian investor and went to office or went to shopping centers or malls. I think in terms of real estate, that's the kind of hot one right now. Yeah. And only because it's sort of new and it's where everybody's talking about AI. Well, AI's got to be supported by data centers.
That's true. Yeah. And that's a whole different conversation there. It's super hot. Yeah. Super hot in every industry. And if you don't use it, you're going to fall behind. Yeah. So there was, I had made a video around fractional real estate investing. It's where you can use like a middleman platform, like I believe like Arrived Homes, Loft Homes or Lofty Homes, something like that, where you go to the platform, you're around other fractional real estate investors, and you can actually buy into a property. Yeah. Yeah. Commercial real estate, industrial real estate. Yeah. But you don't have to necessarily have a lot of money. Like the minimum you have to have is around $1,000 minimum. And then in order to invest in like a commercial real estate property that's like worth multi-million dollars, you got to be pretty much an accredited investor. Mm-hmm. Minimum net worth requirements, minimum income requirements. And so like, would you say, I mean, we've talked about this like throughout the conversation, but you mentioned REITs. Is there anything else you recommend for like a beginner investor to get into commercial real estate?
Yeah, I would say that those fractional things that people need to be aware of how they're structured. Mm. Okay, so let's say you have $100 to invest in those. Mm-hmm. You're going to spend maybe 15 of those dollars to the promoter who lined you up with this. You're going to spend $15 in total to the promoter, to a real estate broker, to somebody to manage the property. And then all of a sudden you've got $85 invested in real estate, not 100. Your 100 is now whittled down to just 85. Now, so that's one thing. What is your return on $85? If they were promising you 7% on 100, well, now you're only getting a lot less on 85 that's in real estate. Yeah. So that's one consideration for you too. How do you get your money out? What's the exit strategy? It depends on the promoter and when they decide to disband the fund. They can tell you that they've got somebody that will step in and take your share, but that is not guaranteed. They can't guarantee that. So that's a concern. You know, REITs are an easy way to invest $1,000 across a variety of things, and you can do an ETF that invests in REITs, and they've got a kind of a bundle of REITs for $1,000 and get a 4 or 5% return, and there you go. You've invested in real estate. A couple REITs are dividend aristocrats. Do you know what that is?
Yeah.
Okay, so there's a couple REITs out there that have been paying dividends, increasing dividends for 30 plus years.
Yeah.
Take a look at how those guys have returned over time. I think you would find that they're 12 to 15% annual return over a 30-year period, which is pretty good.
Yeah.
And you're not dealing with the day-to-day real estate issues, and you can get the money out when you need to.
Yeah, a lot more liquid.
Yeah.
A lot more liquid.
Yeah.
Got you. Are there any, like, is there a dividend yield that you say to, I guess, like, stay around? Like, is there a good average dividend yield that you typically?
It's kind of back to what I mentioned earlier. It's investing in cycles.
Okay.
So if you think apartments are kind of out of favor at the moment, they're going to return a higher, maybe a 6 or 7% yield.
Wow.
Whereas data centers are 2 or 3. So investing in apartments at 5 or 6 or 7% yield, and hope with the hopes that it's going to increase in value, you've got some upside there. That's kind of the way I would recommend looking into that.
Yeah. Okay. Okay. Well, cool. Is there anything else that you would like to just tell the audience, either about like investing or get into a career within commercial real estate or whatever comes to mind?
Yeah. One thing, what you asked me to kind of go back to my background on this, and one thing I thought maybe it'd be worth saying, because it would certainly help for me, but I have 44 years in this business. That's all I've ever done. The first 18 years of it, I was a real estate company guy for Holiday Inns and Wendy's and Quaker State and Arnold Palmer.
Yeah.
But I was an expense. I didn't know how to make hamburgers. I didn't know how to run a restaurant. I didn't want to run a restaurant. I liked real estate.
Yeah.
Right? Until I got with a company where I knew how to make money for the company. In other words, I took my real estate capabilities to a company that was a real estate company. I stayed in one city for 30 years. I stayed with one company for 28 years. So that to me, find something you love, and then go to a company that does what you love, and that kind of helps.
Yeah.
As opposed to, I went to Wendy's and worked as a real estate guy there for years and years. And when Wendy's stopped developing, guess what? They got rid of the real estate guys, right?
Yeah.
So
not revenue driving.
Yeah.
You support the operation.
Exactly.
Right?
You're a service to them.
Yeah.
So if you're going to, whatever you're going to be in, go to a company that's what they do.
If you had to go back to in your hometown, smaller town, and come back to where you are today, would you go through the same journey again?
If I knew what I knew today, I probably would have started out in real estate, right?
Yeah.
I would have started out with a company that does real estate.
Oh, got you. Do you think that your previous experience was like I don't want to say prerequisite, but it helped you?
Absolutely. Yeah, absolutely. Because the kind of real estate we acquired with our real estate investment trust was the kind of property I dealt with my whole career.
Yeah.
So it was restaurants and retail, hospitality, entertainment, et cetera. So
were there any risk that you say, not risk, were there anything that would make you second guess going into the industry? Like with all the information you knew now, like if you had a Jay that said, "Hey Jay, this is the risk that you should watch out for. This is things you should look at." Is there anything that comes to mind?
In commercial real estate?
Yeah, in commercial real estate, like within their career in commercial real estate.
I think it's become such an institutional business. It's highly regulated. It's financially, it's financial modeling. It's financial expertise. I'm an old dirt guy, so I'm not sure I would fit in the environment today where, MBAs and smart guys like you know how to fund and access institutional capital for REITs. So I think it's definitely it's a massive business, the REIT and commercial industry, but it's so well securitized now with public capital that it just requires a different person than I was. But certainly there's a lot of folks coming out of school that it's perfect for them.
Yeah, for sure. I was talking to a friend the other day. Obviously, I began in the restaurant hospitality industry. Now I'm in finance. Been in it for over 4 years now. And I always said if I didn't go into finance, I'd probably be in real estate.
Yeah.
Which I don't know in what capacity,
Yeah.
but in some type of real estate. And there's tons of opportunity out there.
Yeah.
So definitely find it fascinating. Like I've learned a lot in our conversation. I know mainly our conversation was just about different things, life, business.
Yeah.
But I learned a lot from this conversation. And so, and I'm sure the audience has too, especially if they're new to commercial real estate. They may be interested in getting into commercial real estate as an operator, as a founder, or whatever that may be.
Yeah.
So thank you for the time
you're
today.
Welcome.
So for anyone that wants to connect with you, learn about your work, is there a best way to reach you?
Yeah, I mean, I'm on LinkedIn. Anybody can always reach out there. I'm also on the score.org website. And so just pop me a message, or what do you call it, a DM?
Yeah, DM, yeah. Or I am, it's the best, whatever.
Yeah, just reach out. I'm happy to answer any questions, help anybody anyway, give them resources. We've got a ton of resources within the SCORE organization for people with all kinds of business interests. So happy to help out anyway.
Well, cool. Thanks again for your time. Y'all, I'll drop his information in the description below so you can check it out. Shoot your shot. You never know how far a conversation or a DM will go. So, all right, Jay, thanks for your time.
You're welcome.
All right,
Enjoy
thanks, Jay.
it. Thank you.
Thank you.
Yeah.